Probably the most challenging thing to do in accounting, public accounting, or really in management accounting, also corporate finance, is to register securities with the Securities Exchange Commission. This is, if you've done this, you've like climbed Mount Everest in accounting. So I'd like to walk through, with Learning Objective 14-2, I'd like to walk through the process of doing this. And the concern here is that the SEC wants to make sure that when a company goes public, that investors will have all of the information that they need in order to make good decisions. And really what the SEC is concerned about is it's concerned about fraud, and it's concerned that the company that's going to issue stocks is not going to be a viable company. And the SEC, remember, does not pick investments. So needs to be very, very careful to draw the line at disclosure and not at picking investments. So the SEC can't say this is a bad investment and therefore it shouldn't be issued. What it can say is that more information needs to be made available to investors so they can make the right decision. So there's a careful balancing act here, and the SEC wants to make sure that everything that investors need to know is out there. This is the Securities Act of 1933, and the basic financial statements needed to be provided are going to be 2 years of balance sheets, 3 years of income statements, 3 years of cash flows, and 3 years of statement of shareholders' equity. And these are the basic financial statements all over the SEC world. This is basically it. I never really understood why companies provide only 2 years balance sheet but 3 years of statement of income. To me, it seems like there should be 4 years of balance sheet, because you should be able to show, if you have 3 years of income, then you should show all of the balance sheets before and after all the income statements. But that's not what they do. It's only 2 years of balance sheets. And everything needs to be presented in a comparative basis. And then there needs to be something called selected financial information that presents key numbers. And this would be total revenues, net income, operating income, total assets, things like that. So they don't need to be complete financial statements, but rather what we call selected or key financial information. And certain securities and transactions are exempt from this registration process. One of them is commercial paper with maturity in 9 months or less. Issues in which the securities are offered and sold only within one state, because the SEC, the Interstate Commerce Clause of the Constitution says the SEC can only regulate, the federal government can only regulate things if they cross over state lines. So therefore, the SEC does not have jurisdiction if you issue securities within a state. That's not to say that the state doesn't have jurisdiction. You know, of course, the state has jurisdiction, and each state usually regulates these types of transactions. And issuance of securities by different governments. So under Regulation A, there are different tiers. Tier 1 would be smaller, and these would be up to $20 million to be issued within 12 months, and these can be exempt from registration if they file something called an offering circular, which is kind of like an easy registration. And it provides financial other information to whoever is going to be investing. And there's no additional reporting that needs to go on, at least with respect to the offering. Tier 2 would be up to $50 million within 12 months, and it can also be exempted with an offering circular, and the financial statements need to be audited. And semi-annual ongoing reports are also required. And Regulation D offers more exemptions. So one of these exemptions is what we call Rule 504. And these would be small issuances up to $1 million. 505 are small issuances up to $5 million. And they have a limit of 35 unaccredited investors. but an unlimited number of what's called accredited investors. Basically, the SEC has regulations determining when an investor is what they call accredited. They need to have a certain level of experience, a certain amount of money invested, I believe, and you can have an unlimited number of sales to them you can take an unlimited number of investments from you. You can work with an unlimited number of accredited investors, but the limit of 35 unaccredited investors, basically, they're concerned that an unaccredited investor does not quite know what they're doing and could be taken advantage of with one of these offerings. A Rule 506 allows private placements of stock of an unlimited amount of securities, and it follows the same rule as 505, but it has this medium area called sophisticated investors. Sophisticated investors know a little more than unaccredited investors, but they're a little under accredited investors. Of course, an accredited investor, I think, would also count as a sophisticated investor. Again, the concern here is that the SEC wants to allow flexibility for smaller growing companies to be able to raise capital, but at the same time not provide them with so much flexibility that they could take advantage of people who don't know what they're doing. So when you hear about startups and startup capital, that's where these rules kick in, and the prior rules also. So, and in fact, when you hear about, these startup capital companies in Palo Alto and in Silicon Valley and things like that, and how do they issue stocks to investors without requiring SEC registration? And the answer is that they're Tier 1 or Tier 2, or they fall within Rule 504, 505, or 506. So you want to issue stock. And the situation here would be that you have a functioning company, and you might be the primary stockholder, but you have other stockholders too. And right now, you have a few investors in the company. And you want to make your stocks publicly available. You want to trade them on the New York Stock Exchange. So this is the process that you would go through in registering these securities for issuance. You're going to need to find an investment banker to serve as your underwriter. And the investment banker, the underwriter, is going to market the securities and distribute them to investors. You'll sign what's called an underwriting agreement, and that's a contract between you, the company, and the underwriter. And it'll list out what the underwriter's responsibilities are and what would happen in the event that you don't sell all the securities, which is like the worst thing that can happen in an initial public offering. Then together, you're going to write up the registration statement, and you'll hire an accounting firm to do this for you, or if you're an accountant, then you'll be hired to do this. And there are many, many different forms that the SEC uses for registering securities. The most common are S1, S2, and S3. So S1 is the form that new registrants would use, and it's very, very comprehensive. S2 is an abbreviated form for registrants who've already issued some stock. And S3 is a brief form for very large companies that have been trading stock for a long time. So let's talk about S1. There's two sections of S1, what's called the prospectus, which is part 1, and part 2 provides more information. And this S1 needs to be signed by the principal executive, financial accounting officers, and the majority of the board of directors. And they're all responsible for the contents of the S1 because there's great stakes here. They're going to use this to issue stock to the public. And then this is sent to the SEC, and it's reviewed by the Division of Corporate Finance. And if you remember, I said they're the ones who we deal with the most. Division of Corporate Finance is very, very careful when they get an S1. And the review process is, I like this term, what they call a customary review. And customary is really a euphemism for very tough. They go through this thing very, very carefully, and they have the option to accept it, which almost never happens, or they can issue what's called a common letter listing the deficiencies that need to be addressed. And then they send that common letter back to the registrant or the planned registrant, and the registrant needs to fix the deficiencies, and they'll go through this process over and over again until the Division of Corporate Finance is happy. And established companies that already have stock widely traded, where there's not so much concern, get a more summary review or what's called a cursory review. And that process can take a while. This can take several months. And then once the statement itself once the DCF has no further comments, then the company can begin selling its securities. And so what it'll do is it'll issue what's called a preliminary prospectus or a red herring prospectus, which has the basic information, and they'll go around and they'll spread that around in order to get people interested in buying the stocks. This is going to be a marketing process. When they're ready to go, they're going to do something, they're going to issue something called a tombstone ad. They still have these, and they'll print them in the Wall Street Journal usually, to let investors know that this stock is coming out. They're going to have an initial public offering. And usually the tombstone ad comes as close as possible to the date, but they won't decide the actual date that they're going to have the initial offering until the night before. So what they're doing is they're looking for a date when they feel like the market is going to have a strong day. And they would not want to issue stocks on a bad day because they're going to get less money for them. And there's even a risk that they might not sell them all. And that would be the worst disaster of all. And this is capital coming into the company. So the more capital the company can bring in, the better. So the company is going to wait and wait and wait until they think the conditions are right. The night before, they'll make an announcement, we're issuing stock tomorrow. And they'll prepare that tombstone ad for the newspaper in the morning. And it's really, today, it used to be a really big deal, the tombstone. Today, it's really just a formality. It's kind of a tradition. So there can be 120 days between when they get that SEC approval and when they actually go ahead and sell the stock. So what the SEC has also done is they've devised something called a shelf registration for large established companies that already issue stock, and then it's really no big deal. So let's say you have a company that has already issued stock and they want to issue more. For them, it's a very simple process because the SEC is assured this stock has been trading a long time and it's reliable. What the SEC really wants to make sure is that when a new company comes in, it's all set up and it's going to be able to handle all the stress of being a public company. So a company that already has been issuing stock for a long time and has established itself does not need to go through a very long process. It's important to go through accountant legal liability in the registration process. Accountants are liable for any materially false or misleading information up until the effective date of the registration, which would be the date that you start selling the stock. So what accountants will do is they'll have what they call the night of the printers. And the night before a decision is made, we're going to sell the stock tomorrow, the accountants will go through the books one more time to make sure everything is fine. They'll issue what they call the comfort letter, and then immediately the company will start printing its registration statements. And today, I don't know if they still have them in paper. I assume that they do. But the real ones are in PDF, of course, and they're going to be posted online. So this will be posted online, and it's really a big event when the underwriter gets the comfort letter and puts together the final registration statement that's going to be issued to the public. It's a really big deal. It's usually done, there's usually a big party, everybody's getting ready, the underwriter is going to get huge fees, The current owners are going to sell a lot of stock and make a lot of money, and pretty much everybody who's involved in this process has put a lot of time into this initial public offering, and now the money is going to be coming in, and some people are going to suddenly become very rich. So it's a time to celebrate. The next day the stock is issued, and usually companies issue the stock at a slightly lower price than what they think it's worth, because they want to make sure they sell everything and they want to sell it as quickly as possible. So they have to set an initial offering price. They're going to set that price on the low side, and then it's going to go. The worst thing that can happen again is that you don't issue all your stock, and that creates a really bad feeling among investors.